In this video, we will take a deep dive into understanding tax loss harvesting, particularly focusing on its implications for individuals in the 12% tax bracket. Let's start by laying out the agenda. First, we will explore the concept of tax loss harvesting. Then, we will look into its implications specifically for those in the 12% tax bracket. Following that, we'll discuss potential drawbacks and some recommendations to consider. Finally, we'll revisit whether TLH is suitable for your situation. Tax loss harvesting involves selling investments at a loss to help offset capital gains and potentially reduce your tax liability. Essentially, when you sell an asset for less than what you paid for it, you incur a capital loss. These losses can be used to balance out the gains you may have earned during the year. Additionally, if your losses exceed your gains, you have the option to deduct up to $3,000 of the excess against your ordinary income. For those in the 12% tax bracket, the immediate benefit of tax loss harvesting may appear minimal. With a $3,000 loss offset, you save about $360 at this tax rate. However, it's crucial to be aware of potential scenarios where you might move to a higher tax bracket in the future, which could lessen this benefit. Also, note that adopting TLH resets your investment's cost basis to a lower price, limiting opportunities for future TLH with the same investment. While tax loss harvesting does have its benefits, there are potential drawbacks to be aware of. One such drawback is the reduced cost basis. When you engage in TLH, you sell a loss-making investment and quickly purchase a similar one, thereby resetting your cost basis to the lower price. This can limit opportunities for utilizing TLH on that specific investment in the future. Additionally, there's a risk of owing higher future taxes if your tax bracket increases when you finally sell the replacement investment at a profit. It's time for a quick quiz. Here's the question. What is the maximum amount of excess loss that can be deducted against ordinary income if losses exceed gains? Is it $1,000, $2,000, $3,000, or $5,000? You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is $3,000. This is the maximum amount of excess capital losses that can be deducted against ordinary income per year, according to the IRS. As you consider tax loss harvesting, keep a few things in mind. Firstly, evaluate your long-term investment strategy. If you foresee needing to liquidate your account soon, TLH may not be beneficial. Secondly, it is wise to ensure diversification, especially if using platforms that automate TLH as it might not align perfectly with your investment strategy. Lastly, beware of the wash sale rule, which can affect your ability to claim losses if you repurchase the same or a similar security within 30 days before or after the sale. Make sure your strategy complies to avoid potential issues. Here's a flowchart to help understand the wash sale rule. If you sell a security and repurchase a substantially identical one within 30 days before or after the sale, you cannot claim the loss. It's crucial to plan accordingly to avoid this rule's implications. Whether tax loss harvesting is suitable for you greatly depends on your personal circumstances. Although you may experience minimal savings in a lower tax bracket, TLH can be advantageous if you expect to be in a higher bracket in the future. It's important to carefully weigh the potential benefits against any drawbacks while considering your entire financial strategy. Thanks for joining us on this journey to understand tax loss harvesting. We hope you found it insightful. Don't forget to like, share, and subscribe to our channel for more content like this. Share your thoughts or questions in the comments below.